And this is our market Skyline piece, which is where we always do a deep dive analysis into the overall financial markets. We take a big picture view. We look at the major components of what's happening out there to give you an idea of what the market posture is. Matt, volatile but neutral right now. What are you seeing in the S&P?
It's shown some strength off the 200-day moving average. We've talked about this multiple times in the past, all the way back here when the volatility first hit at the very beginning of February. Quick little 10% drop movement down in 200-day moving average, double bottom down here, and then it just kind of hung out, hanging out on the beach here on that 200-day moving average. We've talked about this quite a bit, about how important that 200-day moving average is, how it's a buyer zone for the buyers, and if it ever crosses under, if it ever closes underneath that, then it's a sell zone for the sellers as well. So in looking at this, it bounces off, comes back up into resistance, slows down its momentum, and you can kind of tell it slows down as you see this little small body candle right here with a downward movement in price. My expectation coming into this, purely from a technical perspective, is the probability is it should retest the 200-day moving average, in my opinion. So if it's going to come back down to that 200-day moving average, you're talking right around another 60 points to the downside, which is only another 2.5% to the downside. I'm not saying it's going to break it, but I do believe the 200-day moving average will be tested.
You know, Matt, I always talk about how you need to find the trend, identify the pattern, and find the levels in the market. To me, this is kind of a compression pattern. You could debate whether it's a consolidation or even a symmetrical triangle. And one of my mentors, he taught me early on that symmetrical triangles are one of the least predictable patterns and one of the most difficult to trade. What are you seeing here? Do you see more of a compression? Do you see that triangle forming?
I can see the argument of the triangle. If you're connecting the very bottom of the lows here, you can kind of form that triangle in that capacity. But if you're looking at that level, you're looking at a horizontal support level right there at 2,600 as well. I think whether it's a symmetrical triangle, whether you have some type of descending triangle situation, they are very unpredictable to a certain extent. Triangles can break out one way or the other, and a lot of people don't like to trade within that symmetrical triangle pattern. They would rather wait for the triangle to break out of the pattern, or the price to break out of the triangle, I should say. But I'm looking at this more on a decelerating resistance level or decreasing resistance level. I'm not seeing any real strong increases in support here, Tim. Even if you're looking at them from the very, very lows to the very, very lows here, you're talking about the lows go from 25.29 to 25.59, right? So you're talking somewhere around 20, 30 points on the increase in support, but you're seeing a decrease in resistance from 28.78 all the way down to 2800, which is a 78-point decrease in resistance, from 2800 all the way down to 27.15, which is an 85-point decrease in resistance. So you're seeing a lot of more pressure on the downside than you are on the buyer side. The buyers are certainly fighting. There's no doubt about that. They're certainly fighting. They're certainly putting it out there like the buy. But I am seeing a lot stronger resistance level than I am a support level here. And that's why I do believe, especially after the last week and a half in the market, as it's responded back up into resistance, that the expectation would for it to come back down into that 200-day moving average. And you know what? I'm not ready to make a call on whether that 200-day moving average is going to be broken. I'm not ready for that.
Yeah.
There's too much evidence. There's too much evidence on that 200-day moving average to treat that as a buy zone. And I am going to treat that as a buy zone until further notice. But right now, coming into the week, I'm looking to add a couple short positions. I'm looking to add a couple swing trades to the downside, given the fact that I think the overall market should retest the overall resistance zone, because 50 to 70% of all stocks follow the market. So go find some stock in a bearish downtrend, and you have an increased probability on the downside.
You know, you've got a commodity rally going on. You've got cryptos on the rise. The market has been very neutral. Volatility is something I always look at second. Now, you can go through all the different indexes and ETFs and sectors, but after I go through stocks, I go through volatility. Option prices are drying up a little bit. In fact, they found a floor here, 16.55 now. It's not really a high price historically now compared to where we were last year in
For the last couple of years.
2017. The running the running joke on a podcast was, well, Matt, the VIX is at 12. Holy cow, right? It just was down in the dirt for so long. But I'm not seeing as good a credits as I was a month ago or even 2 months ago when the volatility picked up. What are you seeing here in the VIX?
The VIX has found support at 15, the same way the S&P has found resistance right now. With the expectation of the market coming down a little bit this week, and again, things can change. We have some economic news coming out this week. We have the advanced GDP report coming out this week. We have a consumer confidence report coming out this week as well. So you do have some minor economic news this week, not major. You have some minor economic news this week. But with all the political uncertainty, a lot of this analysis is thrown out the door. Political uncertainty, goes there. But let's say we have a normal trading week where we don't see a lot of, political uncertainty. We don't see a lot of the discussions with North Korea. We don't see a lot of the Trump tweets. We just see a normal market condition. I would expect the VIX to go up a little bit. And for people that complain about, we're not getting as big a credit this week as we were, a month ago, go back and trade 2016, 2017, and then complain about the credits we're getting. I think we're still getting some really good credits out there. Obviously, when the VIX was at 25, we're getting, 3, 4, 4.5% on covered calls. We're getting, 10, 15, 20% on credit spreads. Now you're getting 2, 3% on some covered calls out there right now. You're getting 8, 10% on naked puts, but you're still getting 10, 12% on credit spreads. And that's still pretty decent ROI for the probability.
Move on to crude oil for me. One of the big stories of the month, quite frankly, has been the crude spike and the rally in commodities in general, but crude specifically. We talked about it every week in a podcast. Noah and I were doing the market Skyline a couple of weeks ago, and we talked about the pivot point, the breakout, the run. It's been bullish. It stays bullish. And here's another really, really beautiful candlestick. When you pull back crude, you look at the big picture. I remember to start the year, Matt, I was really bullish on crude, and I thought, high 60s, 70s would be about the top, and we're already there. Can this thing break and run? What do you think?
Of course it can. Like I remember that prediction podcast. My entire analysis on crude was going to be somewhere around 55, and that was just based on the assumption that the U.S. shale industry would hit 10 million barrels a day, which they've done, and that has not slowed down crude, Tim. Despite the increase in production out of the U.S., crude is ultra bullish right now. You're looking at this on a weekly chart, Tim, and over the course of the last, 9 months since we found this bottom last in June, July, you've seen crude up 35% over the course of that time frame. It's showing tremendous strength right now on the weekly chart. You drop this down into a daily chart here, and you had a lot of neutrality over the course of the last couple months. But if you look at it over here, once it broke out of this level at 65, it's starting to run again. And we talked about that breakout of 60 all the way back here. Once it breaks out of 60, watch it run. Look at the retrace back down. Same type of concept here. Once it breaks out of these levels, guys, you got to realize breakout candidates are very, very, very powerful. It breaks out, it runs, and I expect that to continue to run in the short term. Now, am I a buyer at these levels? Probably not. Not even probably. I'm not a buyer at these levels just because I think it's already ran quite a bit, but I wouldn't fault anybody who said I'm buying crude right now.
I agree. And this can transfer into, all kinds of different commodities. But even if you just want to go look at energy stocks, there's a lot of some of the best performers this month in the market have been in the energy sector. People benefiting from the rising in crude. So pretty fascinating. Let's look at the gold next. Always metals. And with our guest today, our featured presentation with Pete Thomas a little bit later in the podcast, obviously we got to talk gold here. Gold just failed to break out, and that candle, that whack-a-mole candle, it did try to break 1360, could not do it. Here we are coming back into test support. Are we just range-bound, neutral? It's pretty hard to call it anything but that, right?
Pete and I, we had a really good conversation on gold in the pod, and basically, I think both of our analysis was equal. I mean, both of us saw this as neutral, and hopefully you guys enjoyed that interview with Pete. Pete's such a wonderful, wonderful trader, wonderful, wonderful investor, and you got a range bound situation right here. You've had it for the last couple months between 1365 and right down here around 1310. I personally put the support level. I see the candles up here at 1310, but I personally put that at 1300. If you've been trading gold for the last few years, you understand how important 1300 is to it. It's right there at its 200-day moving average as well. So even if it broke down into 1310, I'm personally putting that at 1300. I expect this to break one way or the other. Not this week. I don't expect it to break this week. But once it does break, and I think Pete said it best, one way or the other, whether it breaks up or whether it breaks down, both of us expect it to run off that. So if you see a close above 1360, 1365, I expect that to continue to move in that direction. Same thing happens here. If it breaks down at 1300, I expect it to move in that direction. But until that happens, I would shy away from taking any aggressive action one way or the other from the buy side or the sell side. I still think the best way to play gold right now is in selling options against it to cash flow.
Yeah, I would agree with that. I don't know how much of a leg it would have on a break from here. I know this long-term compression is probably bottlenecking some of the real players in gold and their opinions and what's going to happen. It's going to be interesting when the break does happen, how far it can take off, and if we can develop a trend. Obviously, we'll revisit that. Let's go into the dollar. Dollar's actually had an incredible week. In fact, Keith King in the Forex report over at Tackle Trading was talking about how the currency markets were so volatile. Breaking up, Matt, actually, breaking out here in the last 5 candles, green candles in a row, and some strengthening candles, expanding momentum candles. Resistance, hold, like what are you seeing right here?
Kind of looking back at the overall pattern, this is coming into the first year shot. Saw some very big movements to the downside, showed slowing momentum, held its support level right here at 88.5. Held resistance between 88 and a half and 90, right around 90 and a half, I would put it. Held that for about a month and a half, just some sideways consolidation pattern. Very similar to what we're seeing in gold. The dollar's showing a little bit of strength right now. The gold's showing a little bit of weakness. I'm not there to call this a breakout yet. I see that at 91. If it breaks out at 91, expect that to run to 92, which is a fairly important resistance level, since old support over here is new resistance. You also have a decreasing 200-day moving average. So it wouldn't shock me to see it go into 92, but I'm not prepared to call the dollar bullish in no capacity. If you look at this on a weekly chart, it shows you a very different picture. You're still seeing overall weakness in the trend. However, the one thing I want everybody to kind of understand is the concept of slowing momentum in trend. As you can see, look at this big movement to the downside all in 2017. It went from 103 all the way down to about 90 and a half, which is about 12 and a half point movement to the downside. In this second movement to the downside, it went from 94 down to 88, which is only a 6-point movement. So as you can see, the movement to the downside literally got cut in half. That is a sign that the trend is slowing down. It is not a reversal signal yet. It's just it's a sign that it could be leading to a reversal pattern. So in terms of that slowing momentum coming back down here to the daily chart, it doesn't surprise me that we're seeing a little bit of strength, especially with the rather dovish the comments coming out of Jerome Powell over the course of the last week. They were very bullish in general on the dollar. So I do expect the dollar to see an increase in price, but I am not prepared to call for that overall long-term downtrend to end.
Take a look at the euro dollar cross pair, and let's talk about how you can use currency markets. We don't really do a lot with Forex trading in our market Skyline, but if you guys ever want to dip into that, I would start with major pairs. With the dollar at resistance, this thing is now sitting at support. So if you get a reversal, a trigger intraday, something like that, the number one traded cross pair in the world is the euro dollar cross pair. Then the dollar yen probably is second. And actually, that may even be flip flopped. I think
euro dollar
they can go
first,
back and forth.
dollar yen second.
Yeah. What do you see here? Same
Same
thing,
thing.
just sitting on
It's
support, could
reverse.
rally back.
I mean, basically, you're looking at the dollar index here, but just flipped upside down because the euro is the base pair, the dollar is the cross pair on this one. So I'm looking at this. I'm looking at a sideways channel on the euro dollar. Much like I was saying, I'm not prepared to call it breakout on the dollar. I'm not prepared to call it breakdown on the dollar. However, it is sitting at support at 122. That 122 level is very, very important. As you can see, it tested here, it tested here, it tested here, it consolidated over here. If you see that 122 break with any degree of force, expect that to come down into that 120 area, which is only about a 200 pip movement, Tim. But a 200 pip movement on a standard lot, that's a 100% ROI is basically what that is. That's a good opportunity.
No, from old currency to new currency, let's move on to Bitcoin. And this is always going to be a part of our conversations. The XBT or the slash BTC, either one would be fine. And I like the Bitcoin futures. As much as I believe the futures introduction into Bitcoin is one of the reasons why it bubbled and crashed, that kind of explosion in it, I also think it's why guys like Pete Thomas talking about it a lot too. So I think it could be really good long-term for the currency. Really a test here, Matt. You've got a little rounding bottom pattern, call it a V, call it a double bottom. Do you see a breakout?
Yes and no, obviously. I mean, if Bitcoin wouldn't shock me if it went to 12,000 in the next 2 weeks, and wouldn't shock me if it retest 6,500 in the next 2 weeks either. It's a very volatile currency, as everybody who ever trades the crypto market knows. However, I am seeing a lot of positives here, right here at 6,500. It found support over here. It's finding support right here, and it just shows tremendous strength coming back into 9,000. I'm not seeing any clear resistance at 9,000 other than this simple, tiny pivot it had right here. I really think this $10,000 mark is the barrier. The one caveat I have with that is right when the 50-day moving average was introduced, the first time it touched it, it came right back down, Tim. We're right there, right sitting on that 50-day moving average as well. It's going to be interesting to see this week if it can show some strength. If it gets up above 9,000, I think a realistic target over the next week or 2 weeks is 10,000. But if it can't, again, the caveat, if it can't, I don't expect a major movement to the downside. So risk to reward, I could see a potential buying opportunity coming in above 9,000, targeting 10,000. Anybody who targets above $10,000 is hoping and praying and wishing, not based
Right.
on analysis.
That's not trading analysis. That'd be more like hodl analysis, which I know
Hodl.
hodl hodl or die, right? I think
always reminds me of Hodor from Game of Thrones,
which is hilarious to me.
Yeah,
that's funny,
when he was yelled Hodor, it just reminds me of the Bitcoin people going crazy when the volatility, is erupting, and they're typing as fast as they can, hold, and it just comes as HODL, right? But yeah,
or Mel Gibson in Braveheart.
Hold. Oh yeah, that's a good.
That's fantastic.
Yeah, that's a good one too. But I honestly, looking at this from an analytical perspective, I think $10,000 is a realistic target on Bitcoin right now. But it does have some minor levels of resistance. I wouldn't get too caught up in this 50-day moving average, Tim. It only tested it once. We don't have a lot of evidence here. There's not a lot of history here, so I wouldn't get too caught up into that. But if you're looking at some of those traders out there, they might look at that. So look at that a little bit. Don't get too crazy about it. I think this $10,000 mark back here, old resistance equals, old support over here, consolidation at 10,000. I could see that coming back in. And also 10,000, a very significant whole number that could trigger some people to take in profit as well.
Yeah, we'll revisit it next week as well, like all these every single week. But one we don't always look at every week, and we're going to today, is the ZN 10-year yield contract.
Yeah.
I read an interesting article at briefing.com about the 10 2-year spread and whatnot, how it's tightening and flattening, and it's going to trigger a recession at some point and all that kind of stuff. Fact of the matter is, bond yields are higher than they've been, and the bond prices have been dropping. Bear market in the bond market here, Matt? The downtrend continue, interest rates going to rise. What do you see?
Yeah, 10-year note going down, yield going up into that 3% area. The 3% could trigger some safety concerns. And what I mean by that is the U.S. government's 10-year note, they just put an auction out there. It's paying out at 3%. It was like 2.97 to 2.99% today. They just had an auction that they're auctioning off a tremendous amount of bonds this week because they have some debt to pay to a bunch of countries, and obviously the U.S. government is a debt-driven country, and they need to go into more debt to pay their bills. That just sounds insane. It does. Even saying it sounds insane. Let's offer more debt to pay old debt. Let's go into more new debt to pay more old debt. Let's pay 3% debt today to pay the 1% debt we were offering 5 years ago. Not a whole lot of fundamental economic sense on that one, U.S. government. But outside of that, that 3% could trigger people that are a little concerned that the economy is slowing down, or the market is too volatile, or the geopolitical risk, or Trump and North Korea or Syria or whatever, or Russia, or whatever it is, whatever people want to make up in their own minds, it might trigger them to go to a flight to safety. And the bond market has not been paying out very high. It's basically been paying out at the rate of inflation. So now that you're getting 3%, you might be a little enticed to a certain extent. Those old bond traders, that's the bond market. For those of you who aren't familiar, that's the old money market, is the bond market. And that's the institutional money market. And so you might see some old money, you might see some institutional money, you might see some some concern for safety, and you might see that come back into the bond market, and that would have a negative impact on the stock market. So if people are flowing out of the stock market to run to the safety of the bond market, which I understand, by the way, I definitely understand, given the fact the volatility in the market has increased unlike any time since really kind of, I would say it's any time since 2011, even the Brexit of 2016, the China of 2015, those recovered pretty quickly, Tim. I mean, those recovered pretty quickly, like within days they recovered. But it was back in 2011 with the European debt crisis of Greece where, it took a couple months for the market to recover. And so that's kind of what we're seeing in the market. And now that you're getting paid 3%, you might see a little bit of that. And the bond back in 2011 was right around that level as well. So it might show you a little bit of concern. Obviously, I'm not a bond trader, but, given the fact that bonds are paying out, 10-year note is paying out at 3%, and the 10-year note is still in a bearish downtrend, you might see some flight to safety.
Well, we're the little guys. When you're a retail trader, you play on the edges. It's what the institutions do. They're the ones who they create the wake. We just jump it, right? We ride it. Yep. The reality is the bond market's huge. It's a huge market, and to me,
mass market.
I'll make it just very simple. The story of the year is not Trump. It's not Syria. It's not North Korea. It's not politics. Not any of that. It's going to be interest rates, and the bond market is a reflection of that. And the volatility is rising interest rates, and I think big money is moving from traditional, equities, which they've been in for so long, and they are starting to move some money around. As yields go up, Matt, I think volatility is going to continue to increase.
Well, Tim,
and the Federal Reserve is expecting to continue to raise rates this year, so it's going to continue.
You gotta love it, Tim, that the Treasury is, and not the Treasury, but the Fed has been so slow on raising interest rates. But at the same, and they even came out the other day we're going to gradually increase the interest rate, and the 10-year note says no. Hold my beer. Watch this. And so as the Fed has been very slow to raise interest rates, the 10-year note has been a little more aggressive with that. So, and that's kind of the market saying, I'm not trusting the Fed to a certain extent. But, if you'll remember from 1980 to 2007, the bond market actually outperformed the stock market on average. I think it was like 11 to 9% or something along those lines if you annualize it. And you might see a little bit of that coming. Not anything like that 11%, but you might see a little bit of flight to safety given the fact that we are seeing a little bit of, not a little bit, a substantial increase in risk in the overall stock market.
Very good. This has been our market Skyline. We'll be back right after this break on a live podcast. If you're watching on YouTube, go find us. Go find the rest of the podcast. iTunes, Stitcher, all over the place. Trading Justice. We'll be right back.